Greetings, testing, 1, 2, 3. Your mic doesn't pick up. Or better. What about the camera?
It's just showing.
Oh, we're not going to film it, percent.
Yeah,
Yeah, okay, good. No, I was confused.
yeah.
With the point.
Better with just the slides. That's cool.
Because I mean, even if when it turns on, it faces you,
Yeah.
the room.
Yeah.
I could face it here. But,
Okay.
okay.
All right, recording audio. Okay, all right. So welcome to the financial planning for retirement presentation. My name is Gary Warnica. I'm here with my friend and partner, Steve Saltz. And I'll take the first part of the presentation. Steve will pick up the second part. And we'll get into an overview of financial planning and retirement. And then Steve will dive into a deep dive of a specific technique. All right, Nick. I'll be covering today my personal background, what a strong financial plan looks like, the wealth formula, the rule of 72, and an example. It's a pretty fun example about starting to save early. I'll also talk about tax advantages, retirement savings and spending goals, and then what an ideal retirement income stream could look like. So my background is in aerospace engineering. I was an aerospace engineer for 31 years at Honeywell here in Arizona. And I was introduced to financial advising about 5 years ago when my advisor helped me. And the help was so significant that I decided to join and become licensed and study and become certified. So I did that in 2018 and have been really enjoying financial advising ever since. Next. So a good financial plan has the following attributes. Just like a football team has an offense and a defense, a financial plan has the same, has an offense and a defense. The offense in financial terms looks like building or growing your wealth, and the defense looks like protecting your wealth. So on the portion of the right part of the slide, everything above the line in green is growing your wealth, and everything below the line is protecting your wealth. So some of the defensive strategies that we use are insurance, emergency funds, that's cash reserves, tax planning. Having zero debt is actually very defensive. It's an excellent position to be in. Medical benefits that you have at work are also defensive in nature. And then above the line, we have several strategies for growing your wealth. For example, Roth IRAs, 401ks through your employer, investing, college funds, planning for inheritance, and then other estate planning techniques. So as an advisor, what I do is I meet with people and I understand their starting point, which is to understand just how much of the strong financial plan they have in place, which often isn't very much, but that's okay. That's what I'm there for, is to help get from where they are at the starting point to where they should be at the destination. Next. Okay, we're going to cover the rule of 72. This is a fun math trick. It doesn't have to be scary just by giving it the rule of 72 name. It's just a simple math technique. And what it does is, given the interest rate of an investment, it tells you how long it will take to double your money. Very, very simply stated. So for example, if someone says, I'll give you an interest rate of 1%, you divide 1 into 72, the answer is 72. So that answer means that it takes 72 years to double your money. All right, so that's not very exciting. And what we have here on the slide is an example of a 29-year-old who starts out with a $10,000 investment. So the 29-year-old will not double their money until they're 101 years old. So that is definitely not very exciting. But what happens if they can earn 4%? Well, this math trick is to take the 4%, divide that into 72. The answer is 18. So every 18 years, their money will double. You can see that starting at age 29 with 10,000. In 18 years, at age 47, their money is now worth 20,000, and so on down to age 83, where their money has grown to $83,000. Excuse me, $80,000. Fantastic news. But let's see what happens at 6%. You can see there, if you're reading from the slide, that the same 29-year-old with the same $10,000 investment, now at an even earlier age 77, they've doubled 1, 2, 3, 4 times, and they now have $160,000. That's fantastic news. And then you can see what would occur if you could earn 12% consistently every year. The money would double every 6 years. And you can see by only age 65, this investor has $640,000. That is exciting. Okay, next. This is an example of the cost of waiting to invest. So given the rule of 72, which is a rule about compounding and growing your wealth given an interest rate, we have an example here of two investors, the investor on the left of the table and the investor on the right. The investor on the left starts early. They understand the concept. They understand they need to get started, and they invest $100 a month, so $1,200 a year, and they do that for 21 years, from age 20 to age 40. Okay? The bottom line is they've invested $25,200. All right? The next investor is slow to get started. They really value their Starbucks. They really value going to the movies, going to restaurants, things like that. They'll get started someday, and someday comes around eventually when they're age 40 and they finally get started. They invest the same amount of time from age 40 to age 60. That's also 21 years. So the investment is exactly the same, $25,200. But look what happens. Because of compounding, the 60-year-olds have a very different outlook on the amount of money that they have saved. The person that started early has $162,409. The person that started late on the right has only $50,000. So this is a very interesting and fun example to show you that starting early is the key. With the same investment, the early starter gets many more years of compounding, and the results are obvious. Okay, very fun example. Let's talk about types of tax advantages. There are three main types of tax advantages. Tax or pre-tax contributions. What these do is when you invest in an account that is a pre-tax account, it lowers your income tax. So in other words, you're getting income taxed on less money than you would have if you had not contributed to this account. So it's a very valuable account because it lowers the amount of tax you pay in the current year. All right, the next one is tax deferred growth. Many people do not understand that if you have a brokerage account and you own, let's just say you own Nike stock, and Nike goes up significantly that year, you make a lot of money, you're going to pay taxes on that money because of your capital gains, they're called. But what happens in a tax deferred growth account is those gains are not taxed. They all go back into the account. Every single year, you're gaining and gaining and gaining, hopefully, but you're not paying taxes on those gains. Very good way to save money overall. So a 401k gives you both of those first two that I've just covered. All right. The third type of tax advantage is tax-free distributions. This is later in life when you retire and you start taking money out of those accounts. A tax-free distribution account would be an account like a Roth, and that money comes to you tax-free. Not only the money you put in, but the gains. All of the gains that grew in that account, tax-deferred, are now going to go to you as a distribution that's also tax-free. It's a wonderful way to save money, especially later in life when you start taking distributions. So these three advantages that I've discussed are controlled by the government, and you typically do not get all three. There's only one or two places where you get all three. Can anyone name one of those? Typically not. An HSA, health savings account, is one of those examples. That's why a health savings account is so powerful. One of the downsides is you can't save that much every year, but you need to save. You need to maximize that. You need to save as much as you possibly can, as much as the government allows you to save in there. Do that every single year for as long as possible. The HSA goes with you when you retire. It goes with you if you change jobs. It's yours for the keeping. And For people 65 and older, medical expenses will be one of their highest expenses. This is a way to pay those bills without paying taxes on the distributions. So again, that's one reason why HSA is so valuable, because it takes advantage of all three of these types of advantages. Okay, next. This is a quick sketch to give you some high-level concepts where some risk is located. So we call these buckets, or saving in a bucket type of a strategy. And as you save through life, you're going to be saving in a pre-tax type of bucket. Those are things like 401ks, like we just discussed. You'll also hopefully be saving in an after-tax bucket. Those are things like Roths, like we also discussed. But hopefully you'll have a pension. If you don't have a pension, you can design your own pension using things like annuities. And oftentimes the wealthy use things like life insurance, and they use them very wisely so that they pay into them over time, and then they're taking money out without taxes later. It's an awesome technique. And of course, there's Social Security. And people pay into Social Security just by virtue of working every day. And then that's something you can tap into starting at age 62. All right, with Social Security and with pensions, there typically is no market risk. That's one of the things I want to point out about this particular way of saving. However, in your retirement accounts, your Roths or your 401ks, there is market risk. And you need to manage that by selecting the right funds in your accounts that match your style. Typically, if you're young, you can go higher risk. If you're older, getting closer to retirement, you want to go lower risk. But there's some discussion there based on your own style. Okay, given all the information we've covered so far, go ahead. We're going to use that to show you what an awesome retirement plan could look like. And this is where it gets exciting. So what I'm going to do is I'm going to talk about all of these types of savings buckets. I show them as piggy banks because they're just places where you're saving money. We're going to talk about all of their attributes. And then we're going to give an example about how someone can pull money out of these accounts. And thank you. And how they can really gain some tax advantages in doing so. So that's where this is really going to get exciting. We're going to put some real numbers to this and show you an example of a couple that pulls money out of these accounts. So let's go from left to right. So the first piggy bank is called alternate. This is alternate forms of investing. When you do asset allocations, there's typically 4 buckets. Those are cash and cash equivalents, stocks, bonds, and alternates. Alternates are things like real estate, gold, cryptocurrency, annuities. They're things that are not bonds, stocks, or cash. Okay. In HSA, we've already talked about, that's where you have tax breaks both before and after retirement. So it's a very valuable place to be saving money for retirement. You're going to be getting breaks all along the way. Every year you save, you'll be getting a reduction in your income tax. Okay, the next piggy bank is your after-tax piggy bank. These are things like Roths, and you're going to get tax breaks during the retirement years, but not during the years that you're funding this particular piggy bank. All right, the next one is a pre-tax piggy bank. This is an example of would be a 401k. You're going to get tax breaks during the year that you earn the money that goes into this piggy bank. All right. Another attribute of this slide is I'm showing these at different sizes, and that's because you would want to custom design how big, how much money you wanted in each of these particular types of savings vehicles to optimize that for your particular instance, whether you're married or not, whether you have kids or not, whether you're trying to leave a legacy or not, whether you're risk averse or not, things like that. All of those things factor in, and you design, hopefully with an advisor, how to optimize this situation. Okay, the next piggy bank is your cash piggy bank. Hopefully you're in an interest-bearing account. I have access to an interest-bearing account that's currently at 4.2%, which is extremely good right now. You want to look for things like FDIC insurance, and you also want to look for things like 0 fees. All right, and cash is pretty simple to understand. It's just your cash reserve. It's an emergency fund. It's there for you to tap into when necessary. All right, the next one's a pension. Now, a lot of folks these days don't have a pension, but what I like to do is design a custom pension using annuities. These annuities can be designed very specifically for every client's use, depending on, again, things like legacy, what they're trying to achieve, income needs, those kinds of things. And then, of course, the last one is Social Security. All right, let's talk about some attributes of these. On the last three, there's no market risk, typically. On the ones to the left of that, there is market risk. So your retirement savings, a lot of folks don't realize, but hopefully they do, they're paying attention. As the market drops, their retirement savings can drop. They need to pay attention, or hopefully have some help paying attention. Another thing to point out about retirement accounts is the ERISA rules have restrictions, and you're not allowed access to those monies until after age 59 and a half without a penalty. The penalty is steep, so 10% plus income tax on top of the 10%. So it adds up quickly.
And with the cash account, that's like the accruing interest on, correct?
Right. A cash account, you're paying taxes on via interest, but it's pure liquid, and it's typically the interest you pay on that is not very much unless you have quite a bit of money in there. And the amount you should have in there is custom for each person on how safe you want to feel, your emergency needs, those kinds of things, your expenses. All right, let's say one more word about guaranteed income, the two on the right. And ideally, folks will be planning their lives so that in retirement, their expenses are as low as possible. Now, imagine a scenario where your guaranteed income, let's just say you have a pension. So your pension plus your Social Security is some number. Let's just say your expenses are less than that. That's ideal. The reason that's ideal is because your expenses are always covered. Anything else, if you have money in those other piggy banks, that's all extra. That's your fun money. That's your play money. That's your vacation money. That's your give it to your kids money. That's your go out and live life money, your travel money. But to do that, you plan your life such that your mortgage is paid, for example, or your expenses are reduced. A reduced expense in retirement is better than higher income because a reduced expense is taxed. So there's two ways to make more money at the end of the month. You either make more money or you spend less money. Spending less money is even better because, again, it's not taxed. All right, let's talk about an example. This is where it gets super, super fun, at least for a nerd like me. All right, so we're going to talk about Fred and Wilma. Fred and Wilma are 70 years old. They filed jointly because they're married. And married filing jointly is going to factor in here in just a moment. But let's just say that they pull out, it's the very small numbers at the bottom of the page. I didn't want it to distract from the teaching material there. But in this example, they're pulling out $5,000 from their HSA, and that's going to pay medical bills. Okay? They're going to pull $31,000 out of their after-tax account. Let's just call it Roth. They're going to pull $24,000 out of their 401k. All right. And they're making $40,000 in combined income from Social Security. Okay, if you add all that up, if you've done the quick math, that's $100,000 that Fred and Wilma are making every year. Okay, the $5,000 when you pay medical bills, that's not taxable, doesn't count. The $31,000 from their Roth, not taxable, doesn't count. The $24,000 from the pre-tax bucket, since they got the pre-tax advantage, now they're getting taxed on that, so that is taxable. Okay. In this example, when you do the math, only half of this is taxable. When I say this, I mean the Social Security. Okay, when you do the math and you subtract out the standard deduction, the taxable income is $16,300. Okay, let me say it again. The taxable income on this example, where Fred and Wilma earn $100,000 a year, is $16,300. Let's go see what the tax is on $16,300. Okay, so go ahead, 2 slides to the back of the material right there. These are the 2023 official U.S. government tax brackets. They're in the 10% bracket. Okay, so how would you like to make $100,000 and write Uncle Sam a tax check for $1,630?
Very nice.
That's how you save for retirement. Okay, and with that, are there any questions? No? Awesome. I'm going to hand it over to my partner, Steve Saltz, who's going to talk about a very specific technique. Basically one of the spokes, if you will, on the example I gave about having a good financial plan. This is one very specific spoke with a lot of detail.
Thanks, Gary.
You're welcome.
Okay. My name is Steve Saltz. I work for Longbridge Financial, which is a reverse mortgage company. A little bit about myself before we go forward. I worked over 30 years in the aerospace industry, a lot of that with Honeywell, which is where I met Gary. And I got to tell you, after my kids graduated from college and living their own lives, I'm going to work every day, 60 hours a week, laying off people. I just kind of lost my purpose with work. And so I wanted to retire. But I didn't know what to do next. I'm too young to just not do anything. And my sister was a reverse mortgage loan originator. And she always had these wonderful stories about how helping people, people that were barely making it with the income that they had, or people that wanted to do things like take trips, build home additions that they couldn't afford without great hardship. And I thought, you know, I want to do that. I want to do something that I feel like I'm helping people rather than holding people to impossible goals and then laying them off at the end of the year. And so I started doing that about four years ago. It's been wonderful. Go ahead to the next slide. Longbridge been around since 2006. They're a extremely intelligent company led by a guy that graduated from MIT. They're very focused on customer satisfaction because they know that that's what is makes companies endure through thick and thin over the years. We're 5-star rated. We're an A+ on the Better Business Bureau, and we're number 2 in the nation in terms of size of lenders for reverse mortgages. Go ahead. So, what is a reverse mortgage, or more specifically, what is a home equity conversion mortgage? That's a HECM for short, and that is the government or FHA insured reverse mortgage. There are other reverse mortgages, but the government insured reverse mortgage is called the HECM, the home equity conversion mortgage. It's for homeowners that are 62 years and older. It has a maximum loan amount, but what that means is you don't have to borrow the entire entitlement of your potential loan if you don't want to. And it allows you to continue living in your home without having a monthly income, a monthly mortgage payment. I mean, ultimately, the mortgage is paid off at the end when you leave the house. But between now and then, there's no monthly expense whatsoever with this loan. Okay, next slide. Now there's you know, how much money do you get? That's the first question everybody says. How much money can I get? Well, it really depends on a few factors. It depends on the appraised value of your home. It depends on how much equity you have in that home. Some folks do reverse mortgages with a paid off home that's going to maximize their cash position. Other people use it to pay off their existing mortgage, and then there's hopefully some cash left over to do that. It also depends on the current interest rate and also the age of the youngest borrower. That's a factor as well. Okay, next slide. How are the loan proceeds accessed? There's multiple ways. You can take a lump sum. You can take monthly installments of a specified amount. You can keep the cash that you have access to into a line of credit. We'll talk more about that in a minute. Or you can do a combination of any of those things. It's very flexible, and there's no fee or penalties for any of these ways to access your money. Next page. So the line of credit, it is the most popular reverse mortgage in terms of the government insured programs, and that is because it's so flexible. Unlike a HELOC or a home equity line of credit that you get from the bank, it can never be frozen, called, reduced, terms cannot change. Once you do this reverse mortgage, it will always consistently, your home value can drop 100%, but your line of credit value will always be the same. It will not change.
And it's like how that's possible.
It's in terms of the loan.
Really?
It's in terms of the loan.
Okay.
Yeah. So
Seems like
that's
that's
that. I mean, if you take it a step further, well, what if my home is worth $100 and I paid 500,000 for it and got a reverse mortgage? Well, you still have access to that entire amount of money that you would have access to at the $500 valuation when you sign the loan. Now, if you sold the home, you'd have to pay back the reverse mortgage. But wait a minute, the balance is higher than the home is worth. Well, that's where the government insured mortgage portion steps in. So the homeowner only has to pay for the contribution that the home sale would provide. Anything above that, the government covers with that insurance. Okay, so yes, and the biggest thing with this line of credit is that it continues to grow. If you don't pull out money in your equity that's sitting in the line of credit, then over time it will continue to grow, and that's not interest bearing. That's simply more equity that you're able to access, frankly, because you're a month older and a year older. It allows you to have more of that money. Okay, next page. What can you use the line of credit for? Well, it's really unlimited. There's no restrictions. A lot of people use it for emergency, pull it out when they need it. A big popular thing these days is in-home care. We'll talk about that one in a minute. You can make mortgages if you like. There's no penalty for paying down the principal of the loan. Some people just pay the interest that accrues every month to keep the principal the same. And then, of course, you can use it to supplement income when you have unexpected expenses or market downturns. You don't want drawing some of your assets. So, next page. So, just a quick summary here. A reverse mortgage is a loan, it is a mortgage, but the repayment is not required until you move out of the house, whether you pass away or sell the home or break the conditions of the loan. And those conditions are that you live in that home as primary residence, that you pay property taxes, insurance, and that you keep those 4 things in check. You'll be able to stay in that home under these conditions for as long as you live. Now, the other thing that it does, say you have a mortgage and you do a reverse loan, that mortgage must be paid off. The reverse mortgage will take care of that through the proceeds of refinancing. And what that does is immediately improve your capital because now you don't have much. And honestly, the smartest people use that to their advantage. They don't spend all the money that they make, but they start planning and thinking, saving, bring that money into things make sense. Pretty much 60-year-old. No offense. Again, you can just cash any way you want. There's no restrictions. There are a couple of restrictions. If you are going to annuity or if you're going to hire the state plan services, you have to declare that to the government because there's that kind of stuff. It's too easy to take people in those scenarios. But those aren't restrictions. You can use the cash any way you want. By the way, you've already paid tax on this money, so you don't have to get taxed on it again. When you make that payment, that's post-tax money. And then borrowing on your house with post-tax money, so that's not taxable. However, if there are social benefits like Medicaid, that if you all of a sudden put a big bunch of money in your checkbook, it may modify some of the social programs that you're benefiting. So you need to really talk through that with everybody in that situation. Okay, next. A couple of minutes about reverse mortgage. Years ago, there were a lot of consumer protections in reverse mortgages, and quite frankly, financial institutions got to that, where, say, banks were suggesting that the clientele would do mortgage on their homes so that they could take that money and invest in financial products. Well, that's not the way it works today. There's a lot of consumer protection rules out there, but some of those old feelings are something. First one is, well, not bank will home. Well, that's not true. The final stays in the homeowner's name. The homeowner can say anytime they want to sell the property, but they completely own that home to do whatever they want. Fees are high for reverse mortgages. Well, the fees are very similar to any other mortgage type product. The difference maybe with the reverse is that the government requires the mortgage insurance to be paid, and that takes it up about 1% a year, plus there's a premium as well. And if kids will be left with the mortgage, I pass away and leave the house and again. Well, that's not true. Because the kids will have decisions to make. They can either buy the house by refinancing the loan, or they can sell the house in order to pay back the mortgage. Any money left over after they pay back the mortgage, they get to keep. Now, in the situation where the home is higher, less value principal of the mortgage, the government will step in and cover the difference. There's no other course that will be taken other than that property payback.
So just without that there, you think that from 2019 until now, a lot of people whose
tell you what's happened in the last few years. Increase home values. You have to wait a year. You have to season the loan a year before you can finance it. And so I know many people who got a reverse mortgage in 2018, 2017, and their home value shot at $100. They refinanced in a reverse mortgage again, and they were able to get another $50,000 out of their house just from that. Now, when it goes backwards now, once your home value does better, goes to take money. The terms of that loan, the size of that line of credit, they got the reverse mortgage by high home value will stay the same. Will not be any negative impact. If they go to sell their house and they have maximized the cash out of their reverse mortgage, there might be a situation where they might not be looking at as much equity available as they would have. But the government controls it, so you cannot do a reverse mortgage with 100% of the equity of the home. They control it to 60%. It depends on what the debt is. So there's equity left. Okay. How do we use reverse mortgage as a tool for your lifestyle? So next page. It's a healthy tool. A lot of people over 60 are starting to do with speculation, especially in the 80s and 90s. If you look at a state-run full-time care facility, you're going to pay $3,000 to $5,000 a month. If you look at accessory private places, you're looking at $7,000 a month, or $10,000 if you go to something nicer in the town a month. That's unaffordable. It's crazy. And folks don't want to do that. They want to stay at home. So reverse mortgage is an awesome funding source to pay for in-home care, to pay for modifications to your home, to allow ambulatory people who have ambulatory restrictions to live better in their own home. But it's an awesome tool that becomes more widely known for that reason. Next one, financial planning tool. Gary did an excellent job describing how we can be smart about making our money work for us. And with a reverse mortgage, that would be an asset classification that runs through at least your 401k and all the other things. It's a piece of the strategy where you can then when to pull money out of the reverse mortgage in order to prevent loss from some of your higher risk investments. It's not to fixing over companies twice as long as it's going to be for it to shrink. It's a good tool. I'm going to go into much detail. You have time about Gary to really sit down with you and understand your situation, how to effectively use this. There's a lot of smart financial people that have good things to say as well. I'm going to read those to you as well. Here's why you can use a reverse mortgage to purchase a home. How that would work is that you find a home you want to purchase. You finance part of that purchase with the proceeds from the sale of your existing home. And then you come in with a reverse mortgage loan to pay for another substantial piece. So basically, you're putting down one down payment, a big chunk of down payment for the new home, and then you don't have a mortgage payment after that. So, who would this appeal to? Well, people who live with their kids, people who want to move back into town where their healthcare is, people that want to downsize, get rid of the big house with 5 bedrooms and 3 baths, and stuff something smaller, easier to take care of. People that want to scale, they want to live in a more expensive home than they normally would be able to buy because you're only getting. In fact, I helped a lady a couple of years ago. She had $180,000 moving from California, and she wanted to live in Arizona. Well, guess what? You can't find anything that's not on deals. $180,000 in Fresno. So we talked to her about it, and she went ahead and purchased a $300,000. I can't remember the numbers exactly. $300,000. She put down $50,000 to purchase that. The reverse mortgage paid for the rest, and she put $30,000 in her pocket on top of that. And she doesn't have a monthly mortgage payment. So the reverse mortgage really helped her. Someone like that in her situation. It's pretty good. Next page. So how does that really work? So you buy a home for $300,000 purchase price. You take $116,000 as a down payment from the sale of your home, and you use $144,000 from the conversion mortgage to fund that purchase price. So 160 plus $300,000 of your making the purchase of your home. That gives you $131,000 additional money because you use a reverse mortgage to help out how you don't have to house payment. It's going to have to maintain property, pay property taxes, pay home insurance, and live in the home as a private residence. And an anti-anxiety tool. Gary mentioned to me earlier that the biggest cause of stress for seniors is finance. And the greatest reason for seniors seem to be dying is stress and finance. So this is a great tool. If you're clipping along once a month, this is a great tool. And not only to put together a cash reserve, to be able to clear your credit cards with an influx of cash for in your home, but also to put your monthly cash flow by making that mortgage payment account. Okay? So the next step here would be to reach out to me, set up a time where we can get together, have a discussion, help me understand your needs. I can design a program that will help your lifestyle become what you want it to be, remove those stress points, and allow for you to really live a better period of time in your senior years. And I'm happy to talk to you, real estate agent, financial professional, whoever, son, daughter, lawyer, whoever you make you very much. And Gary, thank you for doing this with me. I hope you all